The Federal Reserve has one of the toughest jobs in Washington right now, trying to steer an economy that's shifting quickly using one blunt tool, setting interest rates, all while under intense political pressure. Research from regional banks shows just how complicated the picture is. Let's break it down into three big themes: immigration, tariffs, and artificial intelligence. First, immigration. Some economists argue that the U.S. labor market looks pretty weak right now. But research from the St. Louis Fed suggests that data may look a lot weaker than it really is because of the backdrop of slowing immigration. Earlier this year, for example, these researchers estimated that the U.S. needed about 150,000 new jobs a month just to keep pace with expansion. Now, with fewer immigrants, that break-even rate could be closer to 50,000 new jobs a month. Next up, tariffs. The Boston Fed recently said peak tariff uncertainty may be behind us. That's good news for small and medium-sized businesses, which say easier access to credit outweighs lingering trade worries. Stability, even if completely incomplete, is being read as a positive. And then there's AI. The San Francisco Fed found that companies facing more trade uncertainty are also faster to adopt new tech and automation. In other words, uncertainty is driving innovation. Firms are automating to cushion against policy shocks. Put it all together, and the U.S. economy looks like a complicated mix of adaptation and experimentation in which the data is getting more difficult to read. This week, it's up to Fed Chair Jay Powell to sort through it all and decide how much weight to give each piece.